Joined now by investment expert Roger Montgomery. Roger, great to have you on board this evening. Let's start with Woolies, obviously one of the big stocks and one that we get a lot of requests about and information. How do you think they're travelling? Because they got slaughtered on the market today after this result.
Well, it's not surprising when you look at that result. The result came in up 5.1%. Now, it was actually about 6.5% on a per-share basis. They had a $750 million buyback during the year, and so on a per-share basis, the earnings growth is actually about 6.5% or 6.49, close enough. What investors have to remember that the guidance that the company gave was 5% to 8%. So it's come in at 5.1. So it's right on the bottom end. Now that 5 to 8% is lower than it was 8 months ago, 9 months ago when they were forecasting 8 to 10%. So originally, a year ago, 8 to 10%, then they brought that down to 5 to 8%. They've come in at the lower end of that expectation. And the big issue is that the circumstances that have driven that decline in profit growth, the decline in the rate of profit growth, that's not changing anytime soon.
So it's not cyclical, you don't think? This, the soft consumer and so forth that might get their confidence back?
My view is no. My view is that what's actually occurring here, or what's transpiring, is the making they're sowing the seeds of their own destruction. I'm dramatising that a little bit. They're not going anywhere in a hurry, but what they've done is, this idea that you pressure suppliers, and they admitted today that that's the only way that they can get growth, because they want to keep delivering lower and lower prices to consumers.
And you can't keep doing that, can you? These price wars with Coles.
Look, well, unfortunately, you damage the supplier goes out of business, they sack a whole bunch of staff, those staff are customers. And then you end up in what's called a deflationary spiral. You keep pushing prices down, people go out of business, they lose their jobs, they need lower prices to be able to afford to eat. So you've got to push prices down again, and away it goes. And this is a classic deflationary spiral. What really upsets me is that in China, they know in China that if they have inflation, they're going to have an uprising. It's a huge problem for them. Well, guess what? All the policies in Australia seem to be set towards on the same setting. We have to have lower prices for our consumers so we can be re-elected. It doesn't matter whether it's Qantas. We're not going to let Qantas go out and reduce their cost base and have a hub in Asia. That would be no good. We won't do that. But we'll let competitors come in and compete with our Australian companies. We've got a level playing field policy. Really what that means is let's just lie pronate on the ground and let everyone wipe their feet on us, so that our consumers have lower prices because they'll re-elect us. The difference between China and Australia is that in China they set policy for 200 years. In Australia we set it for the next election. And so it's a big problem, and Woolworths is a participant in that problem. Lowering prices to get profit growth by lowering prices that you pay to your suppliers by even more is not sustainable, and it's not good for our country.
What about all the people then, though, in their superannuation, or whether or not they just hold in their private portfolio, who just go, well, actually, I thought Woolworths was a great company. I hold it. I hold a lot of it. They're thinking, is this thing going to be gone in 10 years? I mean, what do they...
No. I'll hop off my soapbox now. Let's talk about the investment side. So what happens is that you get a situation like Woolworths where you expect slower earnings growth, or maybe no earnings growth. Now, I don't think that's the case permanently. I think that's a situation that they find themselves in, and it may continue for another year or two. What does that look like? Well, it's like a bond. If you imagine a government bond, I saw one analyst put out a research note today, and they talked about they talked about bonds, and they talked about some capitalisation of the dividend as being the price of the bond. But it's not the multiple that Woolies is trading on. That's why you saw the share price drop. The way to think about Woolies now is it's a bond that earns 30%. So the equity is earning 28, 29% or thereabouts. What multiple of that equity would you pay based on the return you want to get for your bond, on your bond? So we think the intrinsic value of Woolworths is about $23 or $24.
So it closed at $25.75 today.
Yeah, so we think the intrinsic value is a little bit lower now. We had a higher intrinsic value based on our expectations for growth. We've now new facts, so we have to reset our expectations. So we now think that intrinsic value growth is not going to be very strong for the next couple of years. And then we'll wait to see how the $1 billion investment in the Masters hardware big box hardware concept's going to go.
Someone came up to you and said, Roger, $5,000 you can choose Woolworths or Wesfarmers, because it obviously is the holder of the owner of Coles.
Yes.
I mean, who ranks higher on the scale?
Woolworths. Woolworths is a better performing business. Its economics look better.
You've got Coles in there as well.
But there's two aspects to the investment decision. The first aspect is the quality of the business, and the second aspect is the value. And Coles Wesfarmers is expensive compared to its intrinsic value. So for me, even though both of them are expensive now compared to our current intrinsic values, Woolworths is closer. So if I was a fund manager that had to be fully invested in the market and I was investing on a relative value basis, I invest on an absolute value basis, but on a relative value basis I would pick Woolies over Coles. Now people would say, but the growth profile is, that's another investment strategy. The growth profile is lower. If I can get Woolies at a big discount to intrinsic value, 20%, 10%, 20% discount to intrinsic value, well, for me, that would tick all the boxes, despite the fact that it's not growing strongly.
So Woolies, a little bit of a re-rating, I suppose. Any others that, through this reporting season you've gone, some that have stepped up or some that have dropped off?
Yeah, well, I'm a little bit... I wrote a piece on my blog this week about Matrix. Now, Matrix is a company that I've talked about a lot. It's a company that, up until Easter time, I thought was a good business and it was cheap, and then I sort of pulled back on mentioning it as one that was worth buying, and in fact in our fund we bought hardly any of it, simply because we were worried from the half-yearly result, we were worried about their cash flow. So and that's been the issue in this result. So I had a couple of people send me emails this week and they said, Roger, I looked at Matrix result, the profit reported was up 85%, earnings per share were up 56%. That's a fantastic result. Why is the share price getting hammered? Well, the reason why the share price is being derated, if you like, which is just a jargon for going down, the reason why it's going down is that the company, when you look at the balance sheet, you see that the cash flow isn't as strong as it was last year. When you look at their order book, at the 6-monthly result, at the half-yearly result, there was $180 million of new orders, the order book, $180 million. And they had $400 million in the tender pipeline. So they were tendering on $400 million of work. Now they're tendering on $500 million of work, but that order book has gone down to $110 million. That $70 million decline in the order book exactly matches the cash receipts in the 6 months. So they haven't won a lot of new work in the last 6 months. Now it could be that they're early, they say that they're early in the order cycle. I'm not quite sure what that means, because that order cycle is sort of a continuous thing that's been going for a while. So they say that they're early. Now, what I've discerned from meeting with the company, talking to Aaron Begley, what I've discerned from actually looking at their results and listening in on the conference call and asking a few difficult questions, is that they really need to make an announcement of a contract win, I reckon, in the next 6 weeks. And if they don't, then there's a possibility that even their 20% guidance for revenue growth for this financial year, 2012, could be under pressure. So that's what I've taken away from the meeting so far. And I'm happy to stand corrected on that, but that's what I think. The cycle from receiving an order to producing the product and then to getting paid is quite long. It's about 8 months, potentially. And so if they don't, and we're already in September, we're coming right up to September now, so really the next 6 weeks is make or break for that target. And I think the market is not convinced and not comfortable that they're actually going to hit that target. So it's wait and see for us. We'd like to see an announcement of earnings, announcement of a contract win. If they do that and they earn 52 cents a share, look, if they get their 20% revenue growth and they maintain their margin, their NPAT margin of about 17%, and I think they'll get about that, then they'll earn 52 cents a share. Consensus analysis is saying 61 cents a share. So I think they'll get 52. So there's potentially some downgrades to come from analysts, and they'll come through. Now, if they get 52 cents a share, I reckon they're worth $6.80 a share. That's what the intrinsic my estimate of their intrinsic value is.
And they're trading anywhere around that at the moment?
They're trading at $4.30 or something like that. So it's a big discount.
Yeah.
But they have to win some contracts to make that 20% revenue growth. So I would rather buy it at a higher price than where it is today, provided I'm certain that they're going to hit their numbers. Otherwise, I'm just speculating about them hitting those results.
All right. So by December you want to see something, or within 6 weeks actually? So
I think in the next 6 weeks, it's 6 weeks. Otherwise, they're under a bit of pressure and they're going to have to explain themselves again to the market.
All right, Roger. Always good to get you on. Thanks a lot for your time today.
Thanks, James.